Thank you, everyone, for listening in on our market forecast. We're very excited to tell you what we're thinking and what we see for 2019. We have a lot to go over, and so we're just going to dive right into it. This is Seth Meisler and
Marc Usem
from the Investment Committee at Affiance Financial. So what we're going to talk about today is a review of what happened in 2018, a summary of the good and the bad, what we're looking at for 2019 and different lenses that we're using to look at 2019 and what we're seeing and why. And also we want to take a pause and look at thinking about bear markets and recessions and how should we be thinking about that and what are the things that we need to do in order to prepare for an eventual bear market and recession. Since we do believe the investment cycles will continue, that there will be bull markets and bear markets in our future. So when it comes to the future and forecasting, we're taking a page from Abraham Lincoln saying, the best thing about the future is that it only comes one day at a time.
So let's look at 2018 and some of the good things that took place last year. U.S. corporate earnings were up significantly, 24% last year. Huge growth there. GDP was strong. During the first 3 quarters, it averaged a little over 3%. Tax cuts helped to boost economic growth. The NAFTA agreement was reworked with Canada and Mexico. The U.S.-Mexico-Canada agreement was signed, although not yet ratified. Unemployment was really low. Below 4%, we were at 50-year lows, meaning people were working and spending. Inflation was modest, appeared to recede a bit actually. We think this continues, this lower for longer sense. Interest rates were a bit higher as the Fed raised rates, making savings more favorable. Now your money markets, instead of earning 0, were actually earning some return, maybe 2% or more. Energy market weakness, well, not great for producers, but for consumers, we got a tax cut. Our gas prices were very, very low. And finally, at the end of the year, kind of a good bad again, stocks were revalued and valuations became much more attractive as stocks went down at the end of the year.
So I'm Mr. Gloom and Doom, and so the bad news of 2018 was trade wars and tariffs, political discord, which resulted in a government shutdown. Currently, as this is being recorded, the government is back open, at least for the next 2 to 3 weeks. Federal Reserve tightened monetary policy in 2018. They raised rates 4 times, so we're now at 2.5%. They also reduced their balance sheet by $50 billion per month. And they also waffled on policy expectations, moving from a robotic raising of rates to something a little bit more nuanced, which actually is more actually good news than bad news. Treasury Secretary Mnuchin discussed bank liquidity publicly, which created a lot of questions in the marketplace. Stock market volatility, which wasn't fun, especially in the 4th quarter, although you can argue that it was more of a return to somewhat normal volatility. Global GDP started slowing down in both in the United States and across the world, and we'll be talking about that later. And debt levels were quite high, particularly in government and corporate debt, which we believe is a slowdown to GDP.
So let's take a quick look back at last year and see what the markets did. So early in the year, January looked really good. Almost all markets were up. And then things started to get a little choppy during the summer as, in particular, trade wars started to heat up. And you can see the dark blue line on the bottom started to fall off around mid-year. That's emerging markets. International, the yellow line toward the bottom, also started to fall off with it as the trade wars heated up. Now, during this time, the U.S. continued to grow, and you can see the gray and blue lines at the top, the gray representing AQE, which is a global portfolio of stocks, and then on the very top, the S&P 500 peaked in October, early October. After that, things started to fall apart a bit, and we started to fall. We had the Christmas Eve decline, which was the low, and you can see the peak to trough returns were really significant. For the S&P 500, down 19.4, international emerging down 22, 26. Those are real bear market kind of numbers. AQE, the global portfolio, off about the same as US, and bonds down 2.7 for the year, the orange line through the middle there. You can see low volatility, but still down a bit for the year. So really, almost all markets were in a bear market, and I like to say we really just had a brush with the bear.
So this is a year that we could say diversification didn't work. And what I mean is that, by and large, everything went down unless you were in cash. So cash was positive and everything else went in the same direction. To be sure, bonds did better than US stocks, and US stocks did better than international stocks, but the basic direction was the same. Bonds were up at 0.01%. However, that actually happened on the very last day of December. If we ended on December 30th, bonds would have been -2. So we took a look at what years that's happened where all asset classes moved basically in the same direction, because it is pretty unusual. However, it's not unprecedented. And we looked at those years, and what we saw is that about half of those years where all asset classes went down, there was a recession. However, on half the years where all the asset classes moved in the same direction, downward, there was no recession. So simply, by virtue of having asset classes move in a downward direction does not necessarily mean that we're in a recession. Clearly, we weren't in a recession, nor that we will be in a recession in the very near future.
So we want to take a look back another year, back to 2017. I think sometimes, unfortunately, investor memories are very short. And in 2017, it was almost the inverse of 2018 to some extent, where emerging markets actually led. Emerging markets, the blue line on top here, up 37% in 2017. So stellar year. International markets up significantly as well, 25. The global AQE up 25. And they all led US stocks, which were only up 21. Still a great year. And again, you can see bonds, very low volatility, but still up a bit, 3.6% for the year. So one of the reasons why we have diversified portfolios, some years international does really well, some years US does well. So we want to have exposure to a global portfolio.
So we're going to move now, stop looking at 2018 and look forward to 2019 and tell you what we're thinking in terms of the economy and stock market. And we're going to look at it through 3 different lenses. One is fiscal policy. Take a look at what's happening in Congress and the president, and that's affecting the economy and markets. The second lens we'll look at is monetary policy. What's the Federal Reserve doing? And the third lens we'll look at it is just general economic indicators and what the economic indicators seem to be showing us. In general, what we're thinking is that global economies are slowing, so they are slowing down. However, we're still seeing growth. Our outlook is that possibility of recession is elevated compared to prior year, but we still don't believe we're going to be seeing a recession in 2019. There are some mixed economic indicators and some yellow flags that we're seeing, and we'll talk about that. And we do expect continued volatility in the marketplace.
So first, let's shift to the tax side. We know the Tax Cut and Job Act of 2017 had an impact. It reduced corporate tax rates from 35 to 21%, it reduced taxes on foreign profits, and it reduced personal tax rates. In the chart on the right, you can see that prior to the tax cut, the U.S. was one of the highest tax regions in the world. Since that time, we've become much more competitive. That 25% range, including state and local taxes, puts us in a much better position globally so companies don't try to go overseas. So that helps. We think the GDP impact of the tax cut last year was about 0.8% boost to our economy. 2018 had strong dividend growth of about 9.6%, and stock buybacks were really significant last year, record high of about $1 trillion.
So keep in mind that the tax cuts that we had in that went into effect in 2018 were both corporate and individual. And so on the corporate side, we both think that it was really good in terms of from a competitive standpoint. On an individual side, we think it's while we think it's positive, the long-term economic effect, we believe, is dissipated, will dissipate quite quickly. And the reason we say that is that we looked at marginal tax rates over time and looked at changes in marginal tax rates and the impact to GDP. And imagine that it's like a car with like a turbo boost or adding nitrous oxide. And in the beginning, when you have that marginal tax cut, there is a boost to the economy. And what we said is, again, that 0.8% impact to global growth or to growth in the United States. But that impact dissipates quite quickly. And within a year, what we've seen is that the growth goes back to its natural rate. And so that's what we think is happening here. We had that one-time impact from the tax cuts, but then we're going to be going back to our natural growth rate, which has been closer to 2% than 3%.
So looking at stock buybacks in particular, the tax cut allowed companies to generate extra cash. And with that extra cash, they did kind of three major things. One is they could pay it out in terms of dividends. Two, they could do share buybacks. And three, they could reinvest in their companies with CapEx. So this is the stock buyback side, and we can see over time it's ebbed and flowed. We are now at a record which we think will be about $1 trillion in 2018. Now it's significant because what it does is reduce the number of shares outstanding, and then sort of by definition, the earnings per share rises. So it's a way that companies can actually manage their earnings a bit, helping to show earnings growth and in turn potentially increase their stock prices. Shifting gears to tariffs. We know that 2018 was the year of tariff headlines. And this is a chart that shows what kind of took place during the year. The red line shows the actual tariffs that were enacted, and the blue area shows those proposed potential tariffs that may go into effect. This definitely had an effect on the market, creating volatility during the year, and was one of the catalysts that made emerging and international markets sell off during the year. All the uncertainty that it created was certainly significant. At the end of the year, we had over $500 billion of potential tariffs on the table. So why does this matter? Well, tariffs raise prices and reduce economic growth. The Tax Foundation did some work on what this might mean, and the long-run GDP impact they estimate at about 0.6% reduction. They also think this may be a cause a reduction in wages of up to 1.3%, 0.4%, and it also will impact jobs. It could create a loss of nearly 500,000 jobs just because these tariffs get put in place. Now, this is a big if. This is if they're enacted and all the threatened ones go into place, and potentially some retaliatory tariffs from China. So potential impact could be actually significant.
And we'll begin to see what's going to happen with that. It's going to come back in the papers in about March of this year, correct?
Yeah, March is the deadline for an agreement, and our guess is that they go right up to the deadline. So why is this happening? Why are tariffs in the headlines? What's going on here? And we think one of the real main reasons is what happened in 2015 when the Chinese government launched the 10-year plan called Made in China 2025. So this was a state-led policy that wants to make China the dominant global high-tech manufacturing country in the world. They're going to use government subsidies, state-owned enterprises, and they say pursue intellectual property acquisition to catch up with and then surpass Western technological prowess in advanced industries, essentially shifting their economy from a resource extraction, low value, low wage kind of country to a high-tech, high productivity economy. So, you know, it's really sort of a fight for global domination in technology. And there's a risk, right? First of all, we don't play by the same rules. So we think there are real risks to the US, including not adhering to WTO rules. There's potential security risks, IP theft and cyber espionage, subsidies that lead to overproduction and dumping. As their government subsidizes certain industries, they may end up producing under cost and dumping those products around the world. And finally, it's not a fair playing field, right? China markets are mostly closed to foreign competitors. Although they want to export their products around the world, we're not really able to export products that we want to China. So in this fight for global domination, the U.S. has taken a hard stance and wants to try to level the playing field.
So we think it's important for those who want to brush up on their world history, what happens when you have the #1 economic power and you then have an up-and-coming economic power that's trying to displace the current, we'll say, top dog. And how does that play out? And every time in history, it's going to play out slightly differently, but it's worthwhile to certainly take a look back and see how that's played out before. The other thing that's important to note is, and I say this with having 3 younger children, that fair does not mean equal. And that's what I say to them in terms of bedtimes or distribution, right? Fair and equal are not necessarily the same thing. And that's going to be a really important thing to note when it comes to trade relations between China and the United States. How China views fairness and how the United States view fairness may be very, very different, culturally different from each other. And we believe that that's going to create more complicated relationships going forward. So the other thing we want to talk about is the government shutdown. When we put the slide together, it was 28 days, went to 35, and it's opened up, at least for now, although we don't know what's going to happen in the next several weeks. And that definitely has an impact to the economy. If the government was shut down for a full quarter, so for 3 months, it would have a 1.1% impact to the economy. Why? For a couple different reasons. One is it reduces consumer spending as government employees weren't receiving a wage. The second thing is that it affects business decision-making since certain economic data isn't released, and so that holds off companies from making investments as well until they get further economic data. So overall, it has a negative economic impact to the United States when the government is shut down. Shifting lenses, so we talked about what the fiscal policies have been lately and what the impact has been to the economy. We now want to take a look at what the Federal Reserve is doing in terms of monetary policy. And keep in mind that the Federal Reserve has 2 mandates. Mandate #1 is to maximize employment, and the second mandate is to moderate inflation. For the Federal Reserve, that's 2% inflation is what they're trying to do. How do they do that in terms of accomplishing those 2 objectives? They really have 2 levers with which to do so. The first one is interest rates, increasing or decreasing interest rates. The second one is moderating their balance sheet by either buying bonds or selling bonds. And that changes the amount of money that's in the system. So how are they done on their first mandate, which is employment? Overall, we would give them an A. Currently, unemployment is at about 3.7%. Look at where it was compared to 2010 when we were hitting 10% unemployment. So in 8 to 9 years, we've had a dramatic decrease in the unemployment rate. Also note that in the last year, we have had a pickup in wages, which overall is a good thing in terms of, from the Fed's viewpoint, that we want to get some moderate inflation into the system.
Let's switch gears for a second to the other side of inflation. Inflation has remained really stable. If you look at this chart that starts in 1996, the Consumer Price Index, you can see the red line in the middle is core CPI. That excludes the more volatile food and energy components that are part of that basket. And it's really been very, very stable around that 2% range, which is the Fed's target. So they've done an excellent job. We'll give them an A on keeping inflation right around where they'd like it to be. Now, the headline number of total CPI has bounced around much more. You can see most recently that oil market crash in 2015 caused the headline number to drop below 0. Of course, the core CPI remained right around 2%. So we think they've done a great job of keeping inflation expectations around that 2% target.
The other way the Fed is managing the economy is by its balance sheet. And what you see here is the top line, the blue line is the federal balance sheet, and the red line is the S&P 500, the stock market, US stock market index. And what you'll see is going back to prior to the Great Recession, the Federal Reserve had about less than $1 trillion on its balance sheet. And in order to pump up the economy and make sure that the Great Recession was only a recession, not a depression, one of the things that they did is they increased their balance sheet quite dramatically. In 2011, they tried to hold off increasing their balance sheet and let the economy take off on its own, and the economy really was unable to do so. And that's where they started, again, additional quantitative easing, effectively buying bonds to increase their balance sheet all the way up to $4 trillion, over $4.5 trillion on their balance sheet. As they increase their balance sheet, it's important to note that the S&P 500 did increase in value. In 2018, they decided that they're going to start decreasing and winding down their balance sheet at the tune of about $50 billion a month. What's interesting to note is as they were doing that, in the first 3 quarters of the year, the economy seemed to be doing okay. However, in the last quarter of the year, the economy really tailed off. And so this is a little bit of an experiment. We've never been here before in a situation where the Federal Reserve has so much on its balance sheet and it's really trying to unwind. And how does it do so without slowing down the economy significantly? In addition, it's really important to know what other central banks are doing. And what we have here is the red line is the Federal Reserve balance sheet, same line that you saw on the previous slide. But now we match it up with the blue line, which is the European Central Bank, and the green line, the Bank of Japan. And what's important to note is that back in 2009, during the Great Recession, we had coordinated monetary policy. All the banks were basically working in the same direction. Back in 2012, European Central Bank tried something different called austerity and tried to radically reduce their balance sheet. That did not work out well for the European economy or the European stock market. And in 2015, they needed to change direction. What you're seeing, though, is that central banks are now working at cross purposes with each other a little bit in terms of some central banks are decreasing their balance sheet, some central banks are increasing their balance sheet all at different times. But the economies are more interconnected today than they were 10, 20 years ago. And so there's spillover effects as each central bank tries to prop up its economy, but it also is helping other economies as well. So even Bank of China as well, as they try to increase their balance sheet to prevent slowdowns, which happened in 2015-16, that had a positive impact on the US economy too.
So looking at monetary policy, the other more sort of well-known lever is the Fed funds rate. The Fed funds rate is the rate that the Fed charges their member banks to borrow from the Fed. It also sets some of the major reference rates, such as the prime rate, and sets rates for adjustable rate mortgages. So it's a very important number, and this is a chart of that Fed funds rate going back to the 1990s. You can see the cycles. As the economy heats up, they generally raise rates, and then as it gets slower or goes into recession, they drop the interest rates. Now, they started raising rates for the first time after their zero interest rate policy, or ZIP, that happened after the recession of 2008-9. We stayed in that position for a very long time, almost 10 years. First interest rate increase was December of 15, and then gradually since then, they've raised rates to try to normalize interest rate policy. Interest rates have gone up to 2.5%, where they are today. And I know, like Seth said earlier, the Fed has changed their tune a little bit about their raising rates. Initially, they thought maybe 3 or 4 times in 2019, and now we think maybe 1 or 2 times, even though the market is saying, hey, we don't want any more Fed rate raises right now. We think they probably still raise rates at least once this year as they try to get to a more normal level of interest rates. This is the same chart, but over a much longer time period, and you can see the different interest rate cycles that took place, especially marked as back in the 1980s when Paul Volcker was the Fed chair. Inflation really started to rear its ugly head, as they say, and they had to raise rates very high to squash inflation expectations. Since that time, inflation has acted much, much more reasonably, partly because they did this, partly because the markets know, hey, if inflation were to get out of control, the Fed's going to step in and they're going to do what's necessary. And you can still see that from a long-term perspective, rates are still very, very low. So why normalize Fed policy? Why is this important? Well, the Fed needs enough room so that they can actually reduce interest rates if needed. Think about interest rate cycles as almost being one in front of the other. They're raising rates today so they can lower them potentially in the future. Now, when rates are very low, sort of that 1% range, they have not a lot of impact if they were to lower rates from 1 to 0, for example. So they want to get rates higher so they can move them and have some impact if needed. The average Fed funds rate since 1991 was 4% before the recession. And now we think their target rate, the Fed funds target rate, is about 3%. Now, if we look back over some of the prior cycles, you can see the green bars on top show where the Fed raised and how far they raised. So back in the 50s and 60s, those 2.7 and 3.3% increases in the Fed funds rate were then followed by 2.8% decreases before those periods when the economy was weak. And so the Fed they need bullets for their gun, if you will. They have to reload, and so they have some ammunition so that if the economy slows down, they can reduce rates again and help stabilize the economy. And you can see the big swings sort of in the 1980s that we were talking about before, almost 20% swings in the funds rate back then. So we think that's important that the Fed does normalize their policy. They have to do it carefully. They have to do it slowly, which they pretty much have. And so we do think it's possible to get another rate increase this year.
Overall, we think the Federal Reserve is in a really tight situation. So a year ago when we gave our market forecast, we talked about that we were living in the punch bowl economy. And what we meant is that if you think about a party, the party goes when there's punch in the punch bowl. But if the punch bowl gets drained, the party very quickly stops. And who's providing the punch in the punch bowl? And that's the Federal Reserve and the central banks that have been doing so since 2009. But at some point in time, the Federal Reserve wants to get to a normal balance sheet and normal interest rate environment. And as they're trying to do so, there's lag effects in terms of the increasing the rate or decreasing their balance sheet and what that impact is to the economy. And what they're finding is that every time they try to do something to try and normalize either their balance sheet or interest rates, they see a very quick slowdown in the economy, almost like a water skier where the speedboat has stopped pulling the water skier. And think of the economy as that water skier. Very quickly, the economy starts sinking. And so this is going to be, I think, the big challenge for the Federal Reserve. How do they get to where they want to be without sacrificing the economy, without completely draining the punch from the punch bowl? And we're seeing is that right now in 2019, they're beginning to back off making significant changes because they don't want to upset the economy.
So the other thing that I want to take a look at here is the yield curve. So the yield curve slide here shows the different interest rates of Treasury bonds from the shortest 3 months to 6 months, 9 months, a year, 2 years, 5 years, 10 years, and 30 years. And what you can see is that back in 2017, the yield curve was fairly steeply sloped, with rates starting at 0.5% and going all the way out to a little over 2.5%. Now, as the Fed raises the Fed funds rate, they directly impact the short rates, and you can see the yield curve start to flatten. So last year, the short rates were about 1.5%. The long end, the 30-year end, is much more driven by some technical supply and demand issues, as well as inflation expectations. And clearly, inflation expectations have been pretty much in check, with very small movements on the long end. Now, as the Fed raises rates, the yield curve starts to flatten, and today you can see that the yield curve is much more flat. If you look at the top line, much more flat at about 2.5% on the short end, again going out to a little under 3% or so, or 3% or so on the long end. And this is important because one of the things that tends to predict recessions is an inversion of the yield curve, meaning those short rates actually end up going higher than the long-term interest rates. So this chart shows that spread, if you will, between short rates and long rates. So if short rates are higher than long rates, these numbers are negative. And you can see before each of the past 3 recessions, the yield curve actually has inverted. And if you go back in time, this has been very consistent in 9 of the last 9 recessions. So we think it's really important to keep an eye on this. We don't think it's different this time. If the yield curve does invert, you need to be careful. Now, just because it inverts doesn't mean there's going to be a recession around the corner. There are lags here, and the lags can be fairly significant. You can see even back in 2006, it was almost 2 years before we actually saw the economy move into a recession. So 12 to 24 months would not be unusual if the yield curve inverts. So it's not immediate. But we still think this is an important indicator to watch, and we will be keeping a close eye on the yield curve.
So we're going to shift lens again, and we just looked at what happens on monetary policy, what the Federal Reserve is doing, and now we're going to take a look at other economic indicators and what we think we're seeing in terms of how that affects the economy. Just kind of a step back to look at the impact of different countries on the economy. We have this cool-looking soccer ball, and you can see the United States represents about 25% of global growth. Europe also represents about an equal amount, they're about the same size as the United States. The number 2 economy outside of the United States is China, at right now 15.5% of GDP. So you can see how quickly China has really grown in the last 10, 20 years to become the number 2 economy in the world. And where do we think we are today in the economic cycle? So we would say we're in the later part of the cycle. We're closer to the end of the cycle than the beginning starting in the bottom of 2009, 2010. And that doesn't mean, though, that there's going to be, the ending is going to be in 2019 or 2020. It certainly can be extended for a period of time, but it is something to keep in mind of where we are today.
So let's take a look at 3 of the major economies, the US, Europe, and China. So first in the US, you can see that the second quarter of last year was really one of the record quarters of growth, over 4% GDP growth, economic growth in the United States. Now in Europe, growth is still positive, but it's been slowing pretty monotonically since the third quarter of 2017. They peaked a little over 2.5% and have started to gradually decline on a quarter-by-quarter basis. Again, still positive at about 1.8%, but slowing. Now China is slowing as well. You can see again there, since the fourth quarter of 2017, their economy has started to slow a bit. Now, the scales are not the same on each of these, so be careful. But if you look at China, for example, it goes from 6.9 to 6.2, so only 0.7% between those. In the US and Europe, you're seeing 0 to 2, 3, or 4%. So much smaller changes in China, yet it's the slowest growth they've seen in 28 years in China, 6.4% in the third quarter of last year. China is really important because they are the global growth engine. Because their GDP is high, at almost 12.5 trillion, 12.25 trillion, they're growing much faster than the US or Europe. So their 6.5% growth rate has a much larger weight on total global growth than the US or Europe. So you can see they contribute about 800 billion to total GDP of the world versus the US at 580 billion and Europe at 380. So small changes in China's growth rate have a very large impact on global growth.
Of course, the challenge with China and GDP is, how do you know what China's GDP for 2019 is?
They tell you.
So the other data point that we're looking at is the ISM, the manufacturing index. And what's important to note here is basically the red line, which is 50. Above 50, manufacturing is growing. Below 50, manufacturing is shrinking. And generally, slowing down of manufacturing is correlated to recessions. And what you can see here is that, and this slide is 54.10. The numbers that we saw most recently is 53.9. So we're still seeing growth. It's off of its highs, which were unusually high at 60. Some of that may have been a result of the tax cuts, but still positive and still growing, still increasing manufacturing. So to us, this looks overall pretty positive.
So looking at leading economic indicators, another way to say, hey, what does the economy look like? And this is a basket of different indicators, including unemployment, including the ISM that we just looked at, including the stock market, including the shape of the yield curve. This basket kind of says, hey, if we look at all these things together, what does it forecast for the economy going forward? And in this case, very, very stable. It's been stable since the early part of 2010-11. We don't see it rolling off, and in prior recessions or before prior recessions, it does tend to trail off fairly markedly, and we're not seeing that at all in the leading economic indicators yet.
So here would be one of the yellow flags that we're seeing in terms of economic indicators, and this has to do with housing. Because of the Federal Reserve raising interest rates, mortgage rates have gone up as well, which are highly correlated to 10-year Treasury rates. So 30-year mortgage rates are now at about 4.5%. In addition, housing prices have gone up too. You can see that the orange line is the Case-Shiller Home Price Index, and it's greater today than it was back in 2007. So what does that mean when housing prices go up and interest rates, mortgage rates go up? Well, less houses get sold because it's more expensive to buy houses. And so we have seen a drop-off in new and existing home sales. And that is a little bit concerning because of the fact that the consumer is such a big part of the US economy, and purchasing of homes and the spending related to the home purchases is a big part of consumer spending. And a slowdown of home sales is a sign of a slowdown in growth, in economic growth in the United States.
So if we kind of wrap this all together and say, okay, well, what's really going on the economic side? We created this little scorecard to tally up the different issues. And so taxes, the tax cuts, that is clearly a positive, we think, at least in the short term. Tariffs and trade wars, negative. The government shutdown, clearly a negative. Federal Reserve normalization, good for the Fed long term, but near term, slows the economy, so a negative. Inflation looks really good. Employment is a positive negative, meaning people are working and spending, which is good, but because the unemployment rate is so low, it does give the Fed, I think, room to think that they can continue to raise rates. The yield curve is still not inverted, although it's fairly flat. GDP is still positive. China is slowing, and that's a negative. The leading economic indicators, most of the indicators are positive, except for housing, which is a negative. So when we sort of add all these things up, we get 6 positive, 6 negative, so we're pretty balanced.
But I think it's important to note that of a lot of the negative ones are what I would call self-inflicted and could change any point in time. And so some of those negatives could drop off quite easily, and we could see more positives than negatives.
Well, we saw the government shutdown sort of end, so at least one thing got done.
Right, and we've also seen the Federal Reserve change its tune both on the balance sheet and on interest rates.
Right.
And certainly the stock market really has reflected very positively on those changes. So again, some of these are pretty sensitive, and especially on the negative can be changed very quickly. That could move things to the positive.
So let's switch gears from looking at economics and statistics to the stock market. We're going to take a look at earnings. We're going to take a look at valuation, some of the stock market volatility. We'll look at corrections and past bear markets. So first, let's look at earnings. Now, I think it's really critical to understand that over time, earnings drive stock prices. And this chart shows the red line, S&P 500 operating earnings going back to the 1980s. And you can see that the stock market, the blue line above, has followed earnings fairly closely over time. Now, sometimes it goes a little faster than earnings, meaning stock prices rise faster than earnings growth, and sometimes a little slower. Now, some of the peaks we called out here in numbers. So back in 2000, the price-earnings ratio, or the ratio of stock price to earnings, was 27.8, so really high before the dot-com bubble. If we go back to 2007, 2008, peaked at about 17 times earnings. And since that time, the stock market's risen quite a bit, where the most recent peak in 2018 was about 19 times earnings. Pretty high relative to the other peaks, although not dot-com, which was quite unusual. Since the correction, though, things have gotten a little cheaper, and the PE at this time, a week or so ago, was about 15.6 times earnings. So fairly reasonable. If we look at PE ratios in time, and this uses a slightly different earnings number, trailing 12 months reported instead of operating, so the number is slightly different, but the same idea over time. This is just the price earnings ratio going back to the 1990s. And we're at about 16.8 times earnings on this indicator. And you can see, based on history, pretty reasonable given where it was in the 2000s, much, much higher, even back in the 1990s. And the big peak at 2008 or so is due actually to earnings dropping off, not because valuations got so high, but because earnings got hit so hard in the recession that denominator, if you will, got very, very low. So you can kind of disregard that. So we kind of think valuations remain quite reasonable.
On this slide, we're looking at is the U.S. stock market performance versus the international stock market performance. And what you can see is that different time periods, U.S. has done better than international, and sometimes international has done better than the U.S. What's interesting is that from 1997 to 2007, the end result is that the returns are roughly the same. It just happened, the performance alternated between international and U.S. However, in 2009, we see a huge divergence in U.S. stock performance and international stocks, where U.S. stock performance grew 271% in that 9-year period, and international stocks only grew 90%. And so significant divergence in performance, and also a significant divergence in valuation. So international stocks are significantly cheaper than U.S. stocks. What does that mean? That means in terms of expected returns on a long-term basis over the next 7 to 10 years, we believe international stocks will have more value or get a higher return than U.S. stocks. Now, that says nothing about what's going to happen in the next 12 months. We have a lot of concerns about international stocks over the next 12 months, with China slowing down and international economy slowing down, and Brexit and Italian banks and Deutsche Bank, etc. So there's a lot of issues over the next 12 months, but our belief of future returns of international stocks outpacing U.S. stocks over the next 10 years is still intact.
So looking at international stock performance versus the U.S., this goes back to 2003, and you can see as the markets grew back in the 2000s before the recession, the international emerging markets grew much, much more than the United States. Emerging markets up 382% during this time period before the crash of 2008. International markets up 150 versus the U.S. up only 100 or so. So huge outperformance international. During that crash period, all markets definitely corrected significantly. But again, out of that time period, international and emerging in particular grew much, much faster than the United States. Now, since that time, since about 2011-12, international hasn't done as well as the U.S. But because the often go up and down at different rates at different times, this sort of is a good picture of one of the reasons, again, why we want to hold global portfolios of U.S., international, and emerging market stocks.
So we kind of gave you our thoughts on 2019, and just to reiterate, our feeling for 2019 is it may be somewhat the inverse of 2018, a little bit of a rougher beginning with trade wars and tariffs in the headlines, but overall we still expect to see economic growth and GDP growth. It's going to be slower than 2018, but we still see positive growth. We still see positive stock market returns, both for US and internationally. Although I think over the next 12 months, international might be a little dicier than the US. Long term, our forward-looking returns based on valuation for US international stocks are still positive. Now, we want to shift gears a little bit and talk about bear markets, because we did have a brush with the bear in 2018, and certainly in international markets and in small cap markets, we did experience a bear market. And so I want to talk about how do we deal with that? How do we think about bear markets, which is different than a recession? And keep in mind, when we talk about a bear market, we're talking about a 20% decline in stocks. And when we talk about a recession, we're talking about 2 quarters of negative economic growth. So they're a little bit different. That being said, bear markets tend to occur when there are recessions. However, bear markets can occur when there are not recessions as well.
So the first thing we want to take a look at here is volatility. I think 2018 is interesting because it's sort of a return to normalcy in volatility. 2017, which was really an outlier, stands out in this slide, particularly the little green dot, if you will, at the bottom. It's really the only year ever in the stock market where every month had a positive return. So people got really used to this really nice, smooth ride of just earning a little bit every month. Well, that's extremely unusual. 2018 volatility was high, but not relative to history. So if you look back here, you can see the number of days that were down a little bit. In the green, 1 to 2, 2 to 3% in the blue, 3 to 4 in the dark blue, and 4 or worse in the gray. And we are definitely much more in the middle now than we were before. And you can see the big spikes back in 2008, and of course 2000, 2002 during the dot-com bubble. But again, our volatility got back to a more normal place instead of thinking that it was super unusual.
So we have to remember that we've been here before. We've experienced stock market corrections. And while 2018 was certainly painful with a 19.4% correction in the S&P 500, again, we've experienced this before. The last time that we've experienced something like this was back in 2011, where the stock market dropped 18.6%. But note that following 2011, we had 6 years of positive growth. And then we had a correction again in 2018. So just the virtue of having a bear market doesn't necessarily mean that we're going to have negative returns in the following years, or it could mean that we still have positive growth. But corrections are a part of investing in the market. When we invest in stocks, we're expecting a return better than what's considered risk-free, and part of getting that return is being exposed to risk, unfortunately. So how frequently are corrections? So a 10% correction generally occurs about every year. So if the question is intra-year, can we expect a 10% correction in 2019? No doubt, because almost every year we get somewhere close to a 10% correction during the year. 15% corrections are less frequent, happen about every 3.5 years. And 20% correction is every 6.3 years or so. And notice, we had a correction in 2018. When was the last correction? 2011, roughly about 6 years or so. So it's simply, that doesn't mean that the next correction is going to be in 2024. We're not that good, but it does mean that corrections are part of a normal investing cycle, and we should expect to see that. It doesn't mean, however, that we should abandon our investment strategy because we've experienced a correction. Looking at this slide, how frequent is it that we have intra-year corrections, and what impact does that have to end-of-year stock markets? So if you look at this slide, you'll see the red dots, and the red dots are the intra-year corrections. The gray bars are the end-of-year returns for the stock market. And notice that intra-year corrections have little to no bearing whatsoever on what happens at the end of the year, going back to 1980. And so we have intra-year corrections. We're going to have intra-year corrections in 2019 as well. That's simply just part of investing in the market. But don't let those intra-year corrections influence what the end result for the end of the year is going to be.
So let's look at bear markets for a second. We talked about corrections, and bear markets, like Seth said, are 20% decline or greater. Bear markets are definitely scary. If we look back, we can see the average bear market was down 33%. Now, clearly 2008, 2009 have a big impact on that average because it was down so much. But they tend to be short, only 14 months on average. Now, if we look at the bull markets, 263% average return over 71 months. So you can see those time periods with the blue lines on top are much, much longer and much, much higher than the bear markets, the green lines on the bottom. So it's important to note that the bear markets are generally short-lived. Yes, they're scary, but we need to stay there, stay invested so that we can reap the bull market returns that happen after those bear markets. This is another slide showing bear markets and recoveries, and the bear markets are on the left, so declines of at least 15%. You can see many years where those declines have taken place, and the subsequent 12-month return after these steep declines is 55%. So again, impossible to time when they start, when they end. It's so critical to stay invested because after those declines, those subsequent returns are so significant, and to miss that has a significant impact on your portfolio. So volatility, again, is scary, and this slide sort of depicts how scary it is. Now, clearly 2007-08 was a very significant event, and the blue lines on the bottom, or the blue bars, I should say, show investors taking money out of the market. Those are negative net flows of money into stocks. So it took a long time. Those flows were negative until 2015. They started to pop up a little bit, went negative again in 16 after that sort of flat period that we call it stealth recession of 2015. And it wasn't really until 2017 that significant flows went back into stocks. So it took a long time for investors to actually get comfortable with putting money back to work again. Of course, right before 2018 and a rough end of year.
So we're going to change this a little bit and look at dollars. We've looked at percentages and try and hit this home with dollars. And what does that mean investing in the bear market? And we looked at really the worst time period in recent history, which was 2007 to 2009. And we want to state that we in no way think that we're going to be repeating 2007 to 2009 in the near future, and hopefully not in my lifetime. But we thought that this was illustrative of what to expect in really, really bad markets, but can help you think through the next bear market that we have, because we know that we're going to have another bear market in our future. When, we don't know, but certainly will happen. So let's go through 2007, 2009, and what happened in that period. If you invested $10,000 on October 1st, 2007, at the bottom of March 8th, 2009, your investment of $10,000 was decreased by 54%. You were left with $4,600. But it gets worse, because if you were invested in international or emerging markets, you were down 59% or 57% respectively. Now, diversification did work, because if you held U.S. Treasuries, 20-year Treasuries, you were up 25%. And the Barclays Aggregate Bond Index was up 8%. Gold, up 26% in that time period. What if you had the guts to invest $10,000 on March 9th, 2009? How would that look 21 months later, 22 months later, at the end of 2010? Well, it would look pretty good. S&P 500 was up 93%. Your $10,000 would be worth $19,260. Emerging markets look even better, 138%. with $23,760. 20-year treasuries, relatively flat. You're down a little bit, -2%. The bond aggregate index did good in that period as well. Not as well as S&P 500, but still a positive return. Gold, surprisingly, had a 53% increase in that time period. So looking at it from holding from before the crash, through the crash, and through the recovery, what would your investment look like? Well, you still would be down in the S&P 500, although not horribly down 13% in that time period. International down more significantly, 22%. So certainly a reason, a case for diversification. Emerging, you'd be roughly flat. Gold, you'd be up quite a bit at 88% in that time period. And bonds did quite well too at 21% for 20-year treasuries and 22% for the BarCap aggregate index.
So if we kind of take a look at those same time periods, but most people don't hold one asset, they hold a portfolio of stocks and bonds. So this is the same exercise, but looking at different portfolios from 100% stocks to an 80-20 portfolio, 80% stocks, 20% bonds, 60-40, 50-50, and then the most conservative, 30% stocks, 70% bonds. These portfolios are just the S&P 500 and the BarCap aggregate bond index. So sort of a simplified version, but if you will, again, the same exercise shows 100% stocks down the most during the crash. Not a surprise, we know bonds did better. Down to that most conservative 30-70 portfolio, only down 15%. That's a huge difference, of course. Now, investing at the bottom of the recovery would have yielded much different results. Again, stocks up the most. We know stocks are the best performing when things recover. And the bond portfolio is doing a little bit worse on a relative basis, with the most conservative portfolio still up 33% over that time period. Now, if we look over the crash to recovery, 2007 to 2010, that 3-year or so period, stocks still down like before, 13%. But now your diversified portfolios did much better, right? 80-20 down a little bit, 60-40 up, the 50-50 portfolio up 6%, and your most conservative, look at that, 30-70 portfolio actually up 13%. And one of the reasons for this is just the math, right? If you're down 50%, you have to be up 100% to get back to zero. That 30-70 portfolio down only 15% in the crash would only need to be up 17% to get back to zero. So much easier for that portfolio, the diversified portfolio, to recover. So again, looking at this period, but not just from the bottom to 2010, but going all the way out to 2017, using those portfolio mixes again. Now what happens here? Your 100% stock portfolio from the bottom until 2017, up 372%. Again, we know stocks over a long period of time do the best, but now your other portfolios do fairly well as well, right? Your 80-20 at 273%, 60-40, 195, and so on. So clearly stocks over a long period of time do well, do the best, but your diversified portfolios really help dampen those difficult periods in the market, and that's why we really recommend diversified portfolios for almost everybody.
So what can you do during a market decline? We know that a market decline, if you ran your financial independence report the day after the market decline, the report's going to look worse than prior to that market decline. So how do you think about that in terms of how does that decline affect you? And keep in mind, when we run these financial independence reports, we don't assume that there's going to be a market recovery like we experienced both in 2009 to 2010 or what we've been experiencing from after Christmas through January. That being said, here are the options that you have available to you. You could either lower your spending or you could not increase your spending with inflation, keep your spending flat for a number of years, because our assumptions are that spending increases each year with inflation. You could do nothing with the expectation that the market could recover. For those who are in savings mode or who have extra bonds, you could buy stocks on sale, rebalance your portfolio, or you could sell everything and move into either cash or bonds, which would be a strategy we would not recommend, as that would most assuredly destroy your financial plan.
So one of the main takeaways here is that, love the quote from John Bogle, the stock market is a giant distraction from the business of investing. So watching the stock market, watching CNBC, watching these things every day is really a distraction from your financial goals, which are a different issue.
So what's our return expectations? Based on where we are today with a PE ratio, our US stock expectations are about 4 to 6% plus inflation, so roughly about 7% return. Our international return expectation is closer to about 6 to 8%. And again, this is over 10 years. That's not any sort of expectation over the next 12 months. And the other thing we want to talk about is thinking about investing in the bear market. We really want you to think about it this long term, gain confidence of what happened in the past. Don't underestimate the power of time and dividends in terms of recovering in those bear markets, and really try to take the emotion out of investing. It's so pervasive, the emotion, it's so hard to get back in the market and so easy to get out of the market when these type of situations happen. And it really can destroy your financial plan.
So one of the things we want to emphasize is staying invested for the long term. So this slide shows what happens over time. So time is really helpful. In the shortest time period, 1 year, the chart shows stocks, bonds, and a 50-50 portfolio of stocks and bonds. And in 1 year, things can be pretty volatile. It could be up 30-40%. It could be down 40% for stocks, 8% or so for bonds, or 15% for a 50-50 portfolio. Now, as time goes on, in a 5-year rolling period, those potential declines become much lower. 10 years, even lower yet, with only stocks having a potential negative return over 10 years. And over 20 years, none of the asset classes or the portfolio has a negative return. So staying invested is really critical. It's also important to know that, again, stocks outperform over time. And in this case, it shows all asset classes do over time. It's not a normal distribution, meaning it's not a bell curve. Stocks don't do well half the time and not half the time. It's much more of a log normal distribution, meaning there are much more positive returns. We like to say stocks go up about 70% of the time than negative returns. So again, critical to stay invested for the long term, both from a return perspective and from a portfolio volatility perspective.
So what are we thinking for 2019? We expect that there's going to be continued stock market volatility, higher than what we experienced in 2017, but more normalized as we experienced in 2018. We think GDP growth is going to be slowing both in the US and internationally.
Earnings, we think, will continue to grow. We think earnings grow probably low single digits in the United States, at least for 2019. We do think the Fed will raise interest rates. One time, I think for sure, maybe two, we'll see. The yield curve could invert. Again, that doesn't mean a recession's imminent, but we're going to keep a close eye on it. And inflation probably stays very much in check around that 2% range.
We're still positive for stock returns, particularly in the US. Longer term, we still believe international stock returns have a higher expected return than US. But that says nothing about what's going to happen in the next 12 months. We do believe European banks will not be normalizing monetary policy as they had originally proposed, and that it's really going to be this lower for longer growth process. There are some wild cards to our expectation. Those wild cards include Brexit and how that's going to play out, trade wars and tariffs that we think is going to be in the newspapers in closer to March, central bank actions. As we've been seeing, they've been trying to figure out how do they deal with raising interest rates in their balance sheet, general political dysfunction, both in the US and abroad, and China. What's going to happen with the Chinese economy, and as well as with trade wars and tariffs with China. Finally, we really suggest that thinking of the long term is really the best way to invest. We believe that it's time in the markets, not market timing, that is the recipe for success. That being said, we really think it's important that you talk to your investment advisor and review your investment time horizon. Make sure that your asset allocation is appropriate with your time horizon. Once you have that set and you're really thinking long term, try and block out that short-term noise, because we don't want the short-term noise to affect your long-term investment strategy. We really believe abandonment of strategy can be detrimental to your portfolio.
Third is understand the value of diversification and rebalancing. We showed some of the slides that show how asset classes move differently over time. So having a diversified portfolio is really critical to reducing your portfolio volatility while also increasing expected returns over time. At the same time, rebalancing is critical to keep your portfolio allocation in line with your targets. Now, rebalancing isn't really designed to be return enhancing. It's more designed to be risk mitigating. Now, we're looking at portfolios to make sure that they are in line with their target allocations. And rebalancing is important. So if you're a 70-30 stock bond portfolio target goes to 75%, we're going to rebalance that back to 70% to keep your risk in line with your target. The same on the downside. If you have a 70-30 portfolio and it falls to 65% stocks, we would rebalance that back to 70 if stocks are down. So the idea, again, is to stay in line with your target risk tolerance or your target risk portfolio over time. Finally, be sure to have emergency reserves for savers of at least a year of cash. So what does that do? A, it makes sure that you don't have to sell when things are down. You don't want to have to be forced to sell to raise cash if markets are weak. That locks in losses. You want to make sure that there's enough cash, that there's a good place to take money from, and that you're adequately reserved for what your needs are over the next 12 months or so.
So with that, we want to thank you for taking the time to listen to what we're thinking about the markets and thinking about bear markets as well. If you have any questions, please do not hesitate to reach out to us or to reach out to your advisor. Thank you again.